Hi guys, welcome to my channel. My name is Burcu, call me Blue. My channel is all about finance. I cover different topics in every video. These are all education purposes. I'm not an investment advisor. Please do your own due diligence. Thank you and enjoy the video. Thanks a lot. Today we'll continue with options. First, I want to highlight today's opportunities in SPY options. One could buy options at $1 and sell them at $3, potentially making 20k profit buying 100 call option contracts on SPY. Let me show you how. This call option on SPY has expiration date August 23rd, basically today, and strike 445. It was being traded at around 0.66 per contract at the market open. I could enter this position at $1, but then I exited my position too early. One could easily ride the trend up until 1 p.m., collecting 20k profit with an initial investment of 10k, buying 100 call contracts at $1 per contract. Now we'll focus on options pricing from an intuitive point of view, and Black-Scholes is highly helpful from that perspective. You can see European call and put prices based on Black-Scholes formula here. And before moving into any detail, let's intuitively think what will be the maximum and minimum price for a call and a put option. Let's take a look at the call option as an example. The lower bound for a call option is the stock price minus the present value of the strike, given the arbitrage conditions. But if this value is negative, options value can be at minimum 0. Imagine that you have an option which is out of the money with no intrinsic value. Would you sell this option with negative price, incurring yourself extra loss? Of course no. Because exercising an option is the right, not an obligation, the holder may not exercise the option, so the price of the option cannot go into negative territory. At the upper bound, however, call option price cannot be larger than the stock price itself. It is highly easy to convince ourselves for this upper bound. You would not pay for an option more than the stock price, where you can simply go to the market and buy the stock at a lower price than the option. Let's now move to the factors that impact the option price. Option prices are determined by underlying, like stock, ETF price, strike, time to expiration, volatility, risk-free rate, and expected dividend. So from this table, you can see the factors that will impact the option price for call and put options separately. For instance, when the underlying stock price increases, then call option price will increase and the put option price will decrease. Time to expiration is another important factor. We will see the theta, the time decay factor, under Greeks. In general, the higher the time to expiration, the higher the option price. All else factors remain the same. Volatility is also a friend of options, just like the time to expiration. The higher the volatility and the higher the time to expiration, the more likely the option can end up in the money at expiration. Risk-free rate impacts call price positively and put price negatively. In a very simplistic way, let's go back here. So if we remove the cumulative probability distributions, this and these, from the Black-Scholes formula, this is the call option Black-Scholes formula, and we remove the and these from here, and we end up with this formula. So you can see that with stock price, with ROE, the interest, risk-free interest rate, and time to expiration, call price increases. You can also see these charts below, and you can see here how changes in stock price, strike, time to expiration, volatility, and risk-free rate impacts the call option price and put option prices. Now let's take a look at the Greeks: delta, gamma, theta, vega, and rho. Delta is the sensitivity of option to the underlying. It's like the probability of the option to expire in the money at expiration. Gamma is the change of delta with respect to the changes in the underlying. Theta measures the time decay, having negative values, is the change in option price with the passage of time. Vega is a sensitivity option to the implied volatility. It's like changing the option per 1% change in volatility. And finally, Rho reflects the option price change with respect to risk-free interest rates. So let's take SPY options with expiration August 23rd, 2021 for strike K447. You can see the calls delta is 0.839 and puts delta as minus 0.169. This basically means that if SPY's price moved from 447.9 to 448.9, then the call price would move from 0.99 to 1.829, whereas put price would go from 0.09 to 0. The reverse happens for a decrease in SPY price. As I mentioned earlier, gamma of an option measures the change in option delta with respect to underlying price. Gamma is highest when the option is at the money. And you can see from the plots that the more the time to maturity and the more the volatility, the lower the gamma. As for theta, we can see how extrinsic value of an option decreases in time. At expiration, extrinsic value is 0 and the entire option value is intrinsic value. If the option is out of the money, then intrinsic value is 0 as well. Vega is the sensitivity of the option price to the volatility of the underlying. At the money options and those with highest expiration have the highest Vega. Let's talk about volatility. There are two types of volatility, realized volatility and implied volatility. Realized volatility is often calculated based on standard deviation of the historical data of the underlying returns, whereas the implied volatility is calculated using the market prices of options and an option formula, mostly Black-Scholes. Implied volatility is calculated as calibration of an option formula to market to back out the volatility. You can see the volatility surface here, and right below that the volatility smile. The smile is skewed because of the investors' more receptivity to protection against downside risk. Thanks a lot for watching. Hasta la próxima. Thank you very much.